What's up, everybody? Welcome to the Power and Science of Money podcast brought to you by your boy King Freeze. And today is episode number 4, and we're going to be talking about the psychology of money. Now, if you haven't seen the first 3 episodes, you most definitely want to check those out because why? They all tie into what I'm talking to you about today. The psychology of money. Probably one of the most important things that you need to comprehend when you're handling money, and especially if you're talking about investing. And this is why. The most important thing is not getting the money. It's not even about how much money you get. It's about how you behave once you have the money in your hand. That's the most important part. Because think about this. Most people won't scale with the amount of money that they get. Now, what do I mean by that? That means that if I'm making $100 a day, my wants and needs are, scaled to that budget. But if I end up getting, let's say, a stimulus package of $6,000, all of a sudden my scale of wants increase because now my income has increased and I spend more because I made more. Now they equal out. It's like matter and antimatter. They're almost like destroying each other. So when you have that kind of psychology when it comes to money, you're never going to save money. You're never going to make money. You're always going to end up losing money. So that's why the psychology of money is the most important thing when you get that money in your hand. Now, my perspective, when I get extra money, the first thing I think about is where can I invest this money? How can I grow it? That's how I think. So because I think like that, I'm able to compound my money. And like we talked about before, compounding money is key. Time is key. Health is key. And when you get this money and you have the right psychology, that's another key. You have all these keys that you're collecting. And if you use these to open up these doors of opportunity, you're going to open up the door to success and wealth if you keep on following these keys. Now, the first nonsense. Oh, well, actually, let me back up a little bit. I read a book every week, or I listen to a book every week. Well, this particular week, I listen to another book that I like called The Psychology of Money. It's about mostly kind of like how you handle money and how you invest your money and what you should be thinking about when you handle money. Now, I also went to a website on YouTube for the Sweetest Investor. He gives a real good breakdown of the 5 takeaways. So that's why I'm going to use that as a point of reference today as well. But I'm going to be giving it my own twist, of course, because, this is the Power and Science of Money podcast. And if y'all wanted to listen to what the Sweetest Investor had to say, y'all just go there. But I'm giving you a more dumbed down and more comprehensive talk about what's going on. Now, the first step is be willing to pay the price. Now, what do they mean by paying the price? Whenever you invest into a company, you're going to go on a ride, especially if you're one of the early investors. Now, in the book, I think they use Amazon or Netflix or one of these upstart companies from the tech-com boom. Now, what if you had invested in one of those companies back then? They went up, the price went up, the price went down, the price went up, the price went down, the price went up, the price went down. Now, are you willing to pay the price to take that ride? Because that calls a lot of your character into play, because if you're not willing to make that ride, most people can say, dang, if I had spent $5,000 on Netflix back in blah, 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 I would be a millionaire by now. Yeah, that would, but you don't know if you would have been able to go through all those ups and downs. Trust me, more than anybody else out here, I understand that because I invested in Bitcoin relatively early, maybe a few years after it already started. And we've went through some rides, baby. We went through some rides. Way up, way down, way up, way down. I mean, some substantial losses. But I'm willing to pay the price because I believe in that particular investment or that particular monetary system. So that's why I'm heavily confident that I can ride it out. Whatever we go through, we will regain. Now, when you invest, you have to have that same mindset. You have to be able to be prepared to go through the ups and downs. You can't let the downs discourage you if you believe in the product that you're investing in. That's why researching is probably the most important thing when you invest. Research. And if you believe that this is temporary and it will recover, then just keep investing in what you've invested in. Matter of fact, you might want to invest a little bit more as look at that as more like a fire sale price on products. That's how I look at it. Now, the second thing is when it comes to money, it's never enough. And I think that's probably, I won't say it's the most important one of all, but is I think that hits home with a lot of people because a lot of people are always worried about what the next person has. What you have isn't enough because you're comparing yourself to someone else that has more. You see what I'm saying? So if you have $1 million, maybe now you're comparing yourself to someone that has $1 billion. Now, if you have $1 billion, maybe you comparing yourself to someone that has $10 billion. So most people's psychology when it comes to money, they never have enough. They always want to be like someone else that they've seen next door or they've seen on the television. And especially now with social media, most people are, psychologically trained to focus in on what someone else has, and then they try to achieve that. And by doing that, they drive themselves down, like financially. They're spending more money trying to keep up with the Joneses, as they say. So that's probably one of the most impactful ways to lose your money. And when you want to train your mind to have the proper psychology when it comes to money, you need to be thinking about what it is that I need for yourself, meaning yourself. What do I need to make sure that I maintain the course that I want to be on and get the things that I need and still be able to invest and still be able to enjoy the other things that I want to do in my life, not concerning myself with others around me. Because more than likely than not, that person that you're looking at is really trying to keep pace with the person in front of them, so on and so forth. So it's a never ending game of chasing the tail. So you won't win that game. So you might as well play your own game. Play your own game and focus on yourself. And I promise once you start focusing on yourself, you'll start seeing your investments making returns that can allow you to buy the additional things that you want for yourself, not to impress others, but to impress and fulfill yourself. Now, number 3, crazy in the eyes of the beholder. The things that people spend their money on seems ridiculous to you, not to them. The book gives an example of lottery tickets. People buy lottery tickets. Most of the average Americans spend about $400 on lottery tickets a year. However, most Americans don't have $400 to cover an emergency. So from the perspective of a person that does not do that, I'm thinking myself, I'm guilty of this. I'm saying, well, if you can't save $400 for an emergency, don't spend the $400 on a lottery ticket, right? But you have to put yourself in the mindset of that person that's buying that particular lottery ticket. They believe that this is an opportunity for them to get out of that hole. They weighed the risk in their head, right? And they rationalized it to the point that they said this is a chance to become a millionaire, billionaire, whatever it is. So to them, it is worth it. Now, why is that important when it comes to investing? Because when someone else is investing in something, you need to think to yourself, yeah, it may seem like a crazy idea to you, but it may make perfectly good sense to them. And that's how you need to approach your investment portfolio. Just because everyone else is investing in something like, i.e., GameStop or AMC, just because the herd is investing into that particular company or whatever or product, doesn't mean that you have to, right? And it may make sense because you're trying to ride the wave, right? But for somebody like me, I'm looking at it from the outside and I have the same psychology. I'm looking at them like, that's crazy. Why would you do that? But I also have to remember that these people are also viewing it and they have rationalized it in their head in a way that may not make perfect sense. But now that I understand that I need to make my investments based off what I think may be happening. And I need to recognize when people are acting irrational, whether it's in their best interest or not, because even though it may be crazy to me, it may make perfect sense to them. But I need to understand that and make sure that I make the right investments to maneuver around whatever obstacle they might be setting for themselves and for me in the process. Next one is, oh man, this is probably the best one. The peekaboo. It's called peekaboo because peekaboo is those disasters that you never see coming: housing crisis, wars, coronavirus. You never see those things, so you have to be prepared to navigate yourself through those things. And how do you navigate yourself through those things? You save money. You save your money. You invest. You keep building your savings account or your investment accounts. You keep building your emergency funds, and you prepare yourself for those incidences that happen in the future, and they're totally unpredictable. Nobody can predict these disasters. If someone says they can predict these disasters, they're lying to you. there's no way. And that actually ties into the next step, which is number 5, which is the seduction of pessimism. When someone speaks in a pessimistic tone, it tends to gather more attention than those that speak in an optimistic tone. Why? Because most times the pessimistic is in the moment. Meaning, like if the market's crashing and I'm talking pessimistically about the market crashing, I'm going to get more attention because I'm speaking about something that's affecting now. Now, when you're speaking optimistically or you're thinking optimistically, you're talking about years down the road. So, like, for instance, I like to pull things back to myself. When the 2008 housing crisis happened and the world was burning and everyone's selling their mutual funds and everyone's selling their gold and they're just trying to get out of the market. Myself, I'm thinking, okay, I think things are going to get better. So I was on the other side investing more money into things that I felt would come back in the years that followed. Same thing with the coronavirus. Last year, everybody in March was selling. I heavily invested myself into a whole bunch of the mutual funds that I liked, and I bought some other stocks that I liked because I felt that the market was being artificially inflated or deflated or adversely affected by coronavirus, which I felt was not it's not the company's fault. It's just something that happened. And I felt like once this thing was over, that the market would come back at least to where it was prior to coronavirus. And I did that. And a lot of my investments have returned back either 100% on returns or in some cases 200%. And that's just getting back up to where they were pre-COVID. Now I'm expecting them to continue to rise and hopefully give myself $400, $500, $1,000. 1,000% return on my investment. So that's probably the most important things when you have money. It's the psychology of money. It's how you deal with money. How much time we got here? It's psychology of money and how you deal with money once you have it. Now, that's a quick 5 rundown, and I hope that I explained it somewhat good enough for you guys to understand. But if you don't understand any of those 5 steps, what you really need to probably understand first and foremost is to always remember that when you get more money, do not spend more money. I'll repeat this again. When you get money, do not spend more money. Save more money. When you get new money, think about how can I save this and invest it and grow it to beat the inflation. That's what you should be thinking. Every pay raise that you get, invest it. Every thing that you sell and you get it in and you don't need the money immediately, invest it. Invest. Do not spend. Because I promise that later on down the road, when you look at yourself, especially like in 10 years or 5 to 10 years down the road, you're going to look at that money stack. And if you invested it right, you're going to be like, wow, I have something that I can use rather than this car that I just bought that depreciated immediately after I drove it off the lot and it's not worth anything right now. So change your mindset, change your psychology when you're dealing with money. And the most important thing to do with your money is to save it, not to spend it. That's what I want you guys to understand. And this particular podcast is going to last just a little bit longer because I feel like this is probably the most important part of money management. You need to understand your own psychology. You need to be brutally honest with yourself. You need to understand your psychology when you have money. Are you a spender or are you a saver? And if you're a saver, are you an investor when you save that money? You need to honestly ask yourself. Don't tell any lies like that to yourself. And the best way to figure out whether you're lying to yourself or not is to look at your bank account and look at your debt to the income ratio. If you make less than that you owe, then you're probably not a saver and you're probably not an investor. You're probably a spender. And if you're spending things, if you get a pay raise and the first thing you do is buy something extravagant for yourself, then you're probably a spender. And you're going to pay the repercussions for that later on down the road. Had you just had the self-discipline enough to hold on for 5, maybe 10 years, you could have just bought that new car cash with no problem while you paid off all your bills and invested that money and grew it over those 5 years. And if you invested it smartly, you would have grown your money by 5 to 10, 15, 20%, depending on how good of an investor you are. So that's probably the most important thing. The psychology of money. I cannot repeat that enough. The psychology of money. Do not spend new money. Invest your new money. I guess you can say delay pleasure for a little while. Because I'm not telling you not to buy the things that you want. Excuse me. I'm not telling you not to buy the things that you want. I'm telling you to delay that for a little while you stack up this money and you invest this money so that it can grow, because the most important things you want to protect yourself against is those peekaboo incidences. You want to protect yourself against coronavirus and all these other things. You don't want to be having the mentality of never enough and chasing the Joneses. You don't want to be looking at what everyone else is doing and saying, oh, that's a crazy thing. I should not do that, or they should not be doing that. Don't focus on that. Focus on yourself. And the seduction of the pessimism. You don't want to be listening to people that's always speaking about things in the moment. I would most likely pay attention to the person that's being optimistic, because those things happen further down the road. And although it's harder to prove a optimistic statement, I feel like if you listen and you research what they're saying, more than likely they are speaking accurately, and it also helps calm your nerves in these peekaboo incidences or market disasters when you taking that ride, when you paying the price for riding the market in the downturn. If you listen to the pessimist, you're probably going to sell your investments and lock in your losses. But if you listen to the optimist, you're probably going to stay in that investment and ride out. Think about all those people that probably dove and jumped out of Amazon and all these other companies at the very beginning, but now regretting it because they listened to the pessimist. And you're listening to the total optimist. And my name is King Freeze, and this is the Power and Science of Money podcast. In the next episode, we're going to be talking about the time value of money. Why? Because I'm currently in school right now. I'm getting my MBA, and we're learning about the time value of money. And I think it ties into these episodes. So that's what we're going to be talking about next episode, the time value of money. Anyway, this has been your man, King Freeze. This is the Power and Science of Money podcast. Until next time, peace.